All right, hello everybody. Thank you for being here today. My name is Lance Lilly. I'm Ecosystem Development Manager at XDC Foundation. So tokenization is said to be one of blockchain's most promising use cases. So today we have the opportunity to speak with a few individuals that are working towards making that happen. So you guys want to go ahead and introduce yourself? Carlos, you want to go ahead and start off? Sure.
Hi everybody, my name is Carlos Domingo. I'm the co-founder and CEO of a company called Securities. We've been in the space of tokenization since the very beginning, since 2018. So we know quite well the evolution of the space. Our company basically operates three businesses. One is a tokenization platform that is wrapped around a license as a transfer agent, which is SEC registered, to be able to basically manage tokens that represent securities on chain. When you tokenize something, for the most part, you're securitizing something, so you turn it into securities. And then we also operate a broker dealer that allows us to sell those tokenized securities. And then we have an ATS, which is secondary market trading platform for tokenized securities, digital asset securities.
Yeah, hi, I'm Niels. I'm one of the founders at TradeTech. We're a London-based fintech, and we provide a platform that allows sellers of private credit assets to very efficiently connect with investors in these assets. We provide a marketplace for private credit. We allow them to interact, do due diligence on the assets, analyze the assets, and then finally transact, meaning to purchase these assets, invest into them. And that's very much driven by the TradFi space. We have done about 3 billion of notes out of our repackaging vehicle, placing these assets with investors. And as we are very much interested in the theme of repackaging assets, making them available for investors, that naturally got us into the DeFi space. And we have been working a number of times now with the XDC network. Recently launched the USTY token, which is a security token out of a Delaware entity issued under SEC exemption, so fully regulatory compliant, that gives you access to an underlying ETF of US Treasuries. And super excited to be working with XDC on that and to be talking about this a bit more today.
Hi, I'm Billy Siebel. I am the Executive Director of the XDC Foundation. The XDC Foundation is an independent entity that supports development, growth and development on the XDC network. The XDC network is an EVM-compatible smart contracts platform. We're focused largely on trade finance and enterprise use cases, and we work, as an example, to collaborate with partners to come online or collaborators to come online, like TradeTech and Securities, to offer the network as part of the technology stack to bringing real-world assets and other assets that people are trying to tokenize on-chain to essentially the crypto markets and the masses.
Yep.
And so,
Yep. All right, thanks guys. Niels, I want to start off with you with a question. So tokenized treasuries has already crossed the $500 million mark, and it's widely said that the tokenization market as a whole could be in the trillions by 2030. What advantages is there to tokenization, right? And what's going to bring that growth? How does that growth happen?
Oh wow, yeah, I think that's a big question, and I think the numbers, maybe to start with that are floating around are somewhere between, I think, 2 trillion. I read 16 trillion as well. So I think there's huge potential. The biggest advantages that I can see is in operational efficiencies and making things more seamless. Making them quicker, making them less subject to breaks and faults that we still see in the traditional world, and just getting things on-chain in a way that also increases financial inclusion. So there are a lot of topics. I don't want to go into too much detail. I think there's a lot we can talk about.
There's a lot of advantages, right?
I see a lot of benefits.
Right, and Carlos, what about you? Is there a specific one maybe that you want to touch on, or that you really think can provide a big benefit, or do you think there's multiple?
No, I think the way I think of this is in kind of like three stages. The first one is operational efficiency, which is what Niels mentioned. That's the low-hanging fruit. You know, when you issue securities, you have to represent them in some sort of ledger, and then those ledgers usually are not very well managed, or they're not digitized, and it leads to reconciliation errors and all sort of problems. So that's kind of like number one step. That really doesn't bring necessarily an advantage to the investor. It's more for the asset manager that becomes more efficient and possibly can save costs and pass it to investors. The second one is that it makes it easier to basically transact with it. So things like redemptions, where you can interact with stable coins in the same ledger and moving money in and out of a fund, or secondary market trading and settling on chain the trades in an efficient way. That's kind of like the second stage, kind of adding liquidity in an efficient way. And the third one, which is what I find the most interesting one, is when the tokenized version of an asset has features that the non-tokenized version doesn't have. So liquidity is one of them, but you can think of more efficient lending against the asset, etc. That will then make the tokenized version more useful and more widely distributed. So.
Okay. Yeah, there's a lot of advantages. I think we could probably go into just that alone, but there's a few other questions that we want to get in. Niels, was there something that you were wanting to add to that real quick?
Yeah, I think it's I mean, we're talking about efficiency a lot, but I think what's good to see where we're coming from and kind of contrast that new world almost with what's going on. And if you think about specifically the operational side, security settlements, where I think a lot of the benefits are going to come from is about 10% of all settlements that are happening today fail. For some reason, mostly driven by human errors. Someone didn't see the trade, it's not there, it hasn't been entered. Just to settle a security trade or a stock trade takes up to 7 different systems that are not connected with each other. The connection is maybe sometimes you have an API that allows the systems to talk to each other. Most likely that's not the case. So you need a human to move from one system to another and a data, and that's where things get lost. So I think by taking things on chain, making that seamless, removing intermediaries, removing human processing, removing the potential for human error, you already gain a lot of efficiency, and that gets us to the point that Carlos described.
Right.
If you think about why capital markets are inefficient, which is what Niels was touching on, the money side of the trade and the security side of the trade, they sit in different ledgers. And then when you trade, you have to swap, right? Like you have to give money and get something, and then get those two systems that are not connected synchronized to settle the trade is what causes all these problems, like the errors as well as the long settlement periods, etc. If you think about why blockchain is such an interesting technology, is because a public blockchain is a ledger at the end of the day that can represent with the same technology in the same ledger both cash as well as securities, and then all these reconciliation problems, settlement periods, etc., they completely disappear because you're in the same ledger. So.
Right, and a lot of people talk about the advantages of using blockchain and tokenization. Even large financial institutions, JP Morgan, Bank of America, quite a few others see tokenization as something that could be a real use case. And talking about some of the advantages we're talking about here, Billy, is it providing those advantages already? Right now, we talk about advantages a lot, but is it really providing those advantages right now? And if not, what is it going to take to get there?
Well, I think obviously we're early in this stage, but it's, I think, more advanced than what a lot of people actually believe. When you start to look at what it takes to actually build out a network, put the rails in place, and essentially create these opportunities for people to bring real-world assets on chain, there's a lot of steps that it takes to get there. I mean, we've been working 2+ years to get to this point where we've been able to offer something like on the network a U.S. Treasury token, and the plumbing, so to speak, now is actually created. And I think that's the thing that I was just having a conversation with somebody about collaboration within the industry itself, and that's really what it takes. I mean, all of us are here because we're able to offer something within the chain that's allowing this to happen. And I think that for us, we're the technology play behind the network side, and we couldn't do what we're doing here today and offering it without TradeTech's expertise and bringing what's traditional in terms of real-world assets on chain and the work that Securities is doing.
Right. Yeah, there's different aspects of it that each one can work on to provide a good service. So Niels, what do you think? I mean, is it providing those advantages right now?
Yeah, I think we're getting there. I'd say, of course, having transactions on chain gives you, for example, the ability to have atomic settlements, simultaneous settlements of trades without delays. But as Carlos said, that does not necessarily track through everything because you have different decks. And I think where we still need to put work in, where we still need development is if I have a trade that has a cash lag, for example, that's not going to be instantaneous. Even if I can settle in theory the security side, the token side instantaneously, the cash side is going to be a few days, and that's not going to go away. The other issue I can see where there's still a break is enforcement of assets. If I have real world assets on chain and something happens that warrants some enforcement action over the underlying real world assets, I still have to do this in the real world. I cannot do this on chain, so I have to almost off ramp to go after the asset. So these are things that are probably solvable over time, but there is no ready solution yet, and more work needs to be done.
Right, and that's the legal clarity kind of aspect of it a little bit, what you're talking, or maybe, I guess you could say standards necessarily. And I want to get into that a little bit, but Carlos, I want to ask you: do you think it's providing those advantages right now? And is there anything maybe that they didn't mention that's sort of missing? Right, the next step. You talked about the stages earlier. Are there other advantages that it's providing right now, and is it providing all of those?
I think that the basic infrastructure to materialize all those advantages is there. I think that the regulated entities with licenses to be able to operate are there, and this was not there before. I think that the proliferation of stable coins, which is required for materializing this settlement, is there. Is it being fully utilized? No, right? So this is still, obviously stable coins are not, it's not clear whether they're legal or not today yet. So a lot of the large institutions don't want to touch them. There is issues with custody as well, which is people overlook that. But once you deal with securities, you have to custody those, and you need qualified custodians, which are only kind of crypto companies today, not the mainstream ones. So I think that for mainstream adoption, there's still some ways to go. But the basic building blocks are there. It's just a problem of getting them together and then put more assets on chain and then bring more liquidity for these things to materialize.
So I guess, Billy, I want to ask you this. So what do you think it's going to take to bring in more traditional financial investors, people that aren't necessarily into crypto or that are used to dealing with digital assets? What's it going to take to bring more of those in to help grow this tokenized market? Billy?
Well, I think there's, in our case right now, what we're actually doing together is putting together something that's most accessible to people that are really within the blockchain space already. And I think that what needs to really happen is, it's a real traditional route. I mean, I think at the end of the day, any type of business that you're building is always about picking up the phone and connecting with the people that you need to connect with in order to bring them on chain, online, into your business. And I think with this, it's no different. There's traditional broker dealers out there, I think that, are important to having access to products like this, and it's beholden on the people that are behind this to really get access to those people, put it in front of them, and really kind of show them what you're able to do. And the USTY token is an example of rails, to me, that allow the inflow of liquidity into this marketplace. It's a very stable product. It's one of the most basic things that anybody would have would be ultimately setting up, years ago, a bank account. Before you had that, you weren't earning interest. You get a bank account, you're earning interest. USTY allows people to get a yield, earn interest, and it's a base product that will allow for many more to come. So I think it's making people aware, it's education, it's getting in front of the right people, and
Right.
that's just a very traditional way to
Right.
make it happen.
I think legal clarity, and there's a lot of it's a real hot topic talking about securities and the legal aspect and digital assets. It's a really hot topic everybody talks about all the time. So, what is it like working, I guess, in that aspect with blockchain compared to, I guess, traditional securities offerings and stuff like that? How is it different, more difficult if it is, dealing with blockchain versus the traditional way?
So look, the regulators first. There is a lot more legal clarity in what we do versus, like, let's say, unregulated digital assets, because obviously it's not clear what kind of whether they're securities or commodities, and what are what the license the trading platforms need to have. This doesn't happen in our side of the business. But at the end of the day, the regulators look at blockchain as financial services infrastructure, right? And when there is financial services infrastructure that is used to put hundreds of millions of dollars or billions in there, they just want to make sure they understand how it works. And there is still a lot of questions about, what happens if there is a fork, or what happens if there is a 51% attack. If it's a public blockchain, who's running the nodes, and make sure they're not like sanctioned entities running them, etc. So I think that the regulators still have those concerns, and then obviously they want to make sure they understand how you're going to be using the underlying technology, not to create any systemic problem, or not to create problems for customers losing their assets, etc., which has happened in crypto many times, right? So they obviously don't want this to happen on regulated stuff. So I think that requires a bit more maturity from the industry side, and a better understanding from the regulator side of what the technology is and what it brings to the table.
Okay.
To be fully materialized.
So it being a security, or working with securities, it could actually make the path a little more clear. There might be more steps involved, right?
100%.
But because you're working with securities, the clarity is there. So you're saying that it could actually make things easier for you guys from a legal and clarity process?
Yeah.
Still using blockchain, it's a problem, right? Because you have to tell them you're using blockchain and for what, and then something that like say a traditional broker dealer could get an approval to do certain things in like 3 to 6 months. It might take us 6 to 12 months, but we can get there and get things approved and done, as opposed to the rest of the digital assets that either don't fit necessarily well on existing regulations, or new regulations are very hard to pass. So
Yeah, I think one observation one can make is that the existing legal frameworks oftentimes already are sufficient to support what's going on, especially common law. Frameworks are very well adapted already, be it in the US or in the UK. Actually, in the UK, the UK Law Commission issued a report recently with recommendations and sort of taking the status of digitized assets. And they found that the common law in the UK specifically is already well adapted. Of course, there are things that need to be done, and they have a few recommendations about additional legislation, but by and large, the law is very well adapted to what's going on. I would say the same thing in the US. When we issued USTY, we did this out of Delaware under a Reg D 506C offering to accredited investors, and that gives you a regulatory framework, a compliant framework to do these things. In the UK, in Europe, MiCA just came into force, so there's a regulatory drive to get clarity, and I think we're going to see more. I think it's even more important, however, to make sure that different regimes in different countries work together, because these finance is global. Real-world assets are global, and if you want to sell them to a global audience, you have to make sure that everything is harmonized. So I think there's more work to be done, but by and large, the legal environment is already coping very well, and the regulators are coming up to speed very quickly.
I agree, but also can give you examples of where existing regulations do not lend itself well to using blockchain and getting all the advantages, and Europe is a good example of that. So in Europe, before the current, it's called the DLT pilot regime, which is the part of the regulation that addresses tokenized securities or digital asset securities. If you wanted to trade anything, whether it's a public security or a private security, you have to go through what is called a central securities depository. It's a centralized entity with their own centralized database that basically settles the trades and keeps track of who owns what, right? And that goes against what you can actually do with blockchain, where the blockchain settles the trade, so you don't need to have a centralized entity, because the ledger, as we discussed, carries both cash and securities, and it settles the trade without the need of a centralized entity controlling that thing. So with this new DLT pilot regime, what they've done is that they've allowed, trading platforms, it's called MTF in Europe, to be able to settle without the need of going through a central securities depository. And that's great because that allows you to materialize the advantages of using the blockchain. It eliminates one intermediary that has, market power, because usually it's one per country only, etc. So some things like, offerings, how do you sell securities, stuff like that is there, and just follow it. But there's all the stuff that, needs to adapt a little bit of the advantage of the new technology, which doesn't fit with existing regulations.
Okay, well, so what do you guys think? This growth is happening, right? Tokenization is happening. It's happening right now. So what do you think the growth, how is that going to affect traditional crypto assets that a lot of people are used to using, and the industry itself? I guess traditional crypto assets. How do you think this growth is going to affect that? Billy, you want to start off?
Yeah, I think I'd kind of start off with a little bit of the conversation that was happening here in terms of the regulatory piece, or from a network perspective. What we have really always tried to do is really bridge the gap between what we're doing with technology to try to meet what needs to happen around the regulatory. And so that's why we are working and collaborating together, because together we're able to offer that. From the tokenization piece and looking at, I think, what needs to happen moving forward, there's the opportunity really is to kind of take what's already happening now and accelerate a process of really kind of volume growth with the opportunity of more products and the higher volume that will follow with those products. And I think that, this is probably something that happens sooner than people actually think is going to happen. If you look back to where we were maybe a year and a half ago or 2 years ago compared to where we are today, I don't know whether anybody would think that this is what was actually going to be happening today.
Right.
And so with that, I think the opportunity for real growth is really in front of us. And so, the regulatory piece is going to come into play. I think what we just try to do on our side is do the right thing that helps us move forward within this arena. And as far as regular assets, like in terms of the crypto space, I think those will take care of themselves. I think security tokens and the ability to bring real world assets on chain are really ultimately the long-term opportunity of what is out there in terms of what we're trying to accomplish.
Right. And when I asked that question, Nils, I saw you kind of smile. Does that mean you have an answer that we probably aren't going to like, or what are you thinking?
No, what I think is we come from an environment where we were always talking about DeFi, TradFi, sort of as two antagonists almost, in two worlds that don't necessarily talk to each other. And is DeFi going to replace TradFi, and what's the implication there? And I think that's to me that's a very sort of 2020 type of conversation almost. I think we're past that. As it turns out, TradFi is not going to go away. It's growing. I think it's now the theme is about how to get more people into TradFi, how to get a real democratization of finance going, financial inclusion, things like that, and how can DeFi help to accelerate that? And for me, there is no inherent conflict between TradFi and DeFi. I see DeFi very much as the rails on which TradFi can run and will run, and it's almost we started this development, and I don't think it's going to stop. And there are technologies that took a long time, innovative technologies took a very long time to get adopted. Even email took 30 years to be fully adopted. I think we're going to see this much quicker in the DeFi space coming into TradFi, and you mentioned a lot of these big institutions that are working on this. I think it's not going to go away. It's going to make TradFi more efficient, but also more has to happen. And I think that's why this collaboration that we have built with Securities, with XDC, getting this yield tech USDY product on chain is so important, because that brings big players, experienced players together, launching a product, a use case, something that actually adds real value and is not just the next crypto project where someone tries to make a quick buck.
Right. Yeah, I think DeFi, a lot was learned from that as far as what's possible. It brought upon the idea. You said Rails, how it can be executed, how things can function. But I want to ask you also, Carlos. What do you think this means? Growing tokenized market. What do you think that means for traditional crypto assets like Bitcoin and others?
So look, there is many things in crypto. Obviously, I think Bitcoin is kind of like a completely different asset class, if you want, and I don't think that it will be impacted negatively or anything like that. And there's a bunch of stuff that crypto people did in between, like NFTs, governance tokens, a lot of tokens that are not backed by anything, that don't have probably they're not sustainable long term, in my opinion. As people start doing things with real world assets on chain, which, by the way, real world assets is a terrible term because RWA in traditional finance means something different. But it's kind of ironic that is being called real world assets as opposed to imaginary assets, which is what a lot of the crypto people were doing before. And I think that as more people realize that, for crypto and blockchain to really become part of the financial services industry, you need to do real productive stuff. The other non-productive part of the crypto space will kind of like slowly die and disappear.
So, we talked a little bit about what's going on right now and what's happening, right? Can you just cover briefly, we only have a couple minutes here, just sort of, you guys have been working in this for a few years now, or for a little while. Just briefly cover, how it was then and kind of how it is now, and what do you think it's going to be like, over the next few years? Just the sort of journey that you guys have been on. Billy, you want to go ahead and just start it off real quick? We got a couple minutes.
Well, where it was, an unpaved road, I think is probably the best way to do it. We're kind of driving on dirt for a while. I often say that we're paving the road as we're driving on it. I think that's what's really going on here. So, unpaved roads go to paved roads, go to highways. More people are using it. I think that's just the general evolution of things, and I think that's what's happening here. This is early, and the opportunity is in front of us. So.
Yeah, I think that's very true. I mean, we have a lot of experience in dealing with real world assets or off-chain assets. Maybe it's a better term, and bringing these to investors in scale. So it's only natural to do this in a more efficient way, which takes us to blockchain technology, to DLT. And the collaboration we built with XDC. So, but it's very much sort of, you make it up as you go, you build the road as you drive on it. I like that mental image very much, because that really is the reality. But we have come a long way, and I think we're seeing these highways now to emerge, and at some point there's going to be this full connected road system.
So look, I started the company in 2018. In 2018, we only have Ethereum. We didn't have other infrastructures like now, XDC and others. The wallet experience was terrible. There were no people with licenses. There was not regulatory clarity in terms of how you settle a trade of a security on chain. There was no institutional participation. Asset managers will not go on tokenized stuff. I'm talking like the traditional ones, etc. So if you fast forward 5 years, a lot of those problems have been solved. So now there's good infrastructure, there is a better wallet experience and wallet management tools. There is traditional people issuing assets on chain, like we've worked with KKR, Hamilton Lane, and others. There is companies that are regulated, that have licenses, that can operate without fear of like doing something illegal, etc. So we've come a long way, and I think the next 5 years is not that much about infrastructure and license. It's about end user adoptance. Adoption is what needs to drive.
Interesting. Well, I think this conversation could probably go on forever if we wanted to, but unfortunately it can't. So Carlos, Niels, Billy, appreciate you guys coming today, and it was a good experience. Thank y'all. Thanks everybody for coming.